Hi everybody, my name is Frank Bunn, and today we're going to discuss why indicators don't work. That is, why indicators can't be used as a viable method for forecasting price. So in order to understand why they don't, we need to understand what the nature of an indicator really is. And so an indicator is a derivative. All right. So if we define derivative is a noun, and it's something that is based on something else. So it's an entity that's based on another entity. All right. That's what's really important. So when we take a look at indicators as a derivative, your indicator is based on price, right? That means that if we think about it in terms of calculus, if you look at slope, that means that there's going to be a lag at some point between, depending on the sample, between price and the indicator. All right. And so because price affects the indicator, then and influences, we need to understand the underlying price action in order to do that. So let's just take a look at a common indicator here. We've got, let's say we're going to look at, we can look at moving averages, or we can look at your like run-of-the-mill stock oscillator. Okay, so moving averages generally, and I get hit up once or twice a week by people who, hey, you know, I have this system that does this and this automated system that does that, always based on some derivative of price that's usually either a moving average or some type of oscillator. So in your general, like run-of-the-mill moving average situation, you've got a short moving average which crosses over, let's say, a longer term moving average. Okay, now that crossover is going to be their signal, in this case to buy. As ridiculous as that sounds. If it was that easy, wouldn't it really be easy? In the case of an oscillator, then, we generally have either two derivatives of price, not just moving averages, depending on how they're derived, and it's generally some type of moving average of price, and then the signal line, if you will be some type of average of that average. So with oscillators, we now have like a double derivative situation going on. Okay, so let's take a look at the moving average. So what has to happen? So price has to do something in order to get this to cross. So price needs to move up. So if we have a series of intervals or time where price rallies, we will get this signal. Okay. Now, this is what's really crucial. Depending on what price does in that area, and we're going to call that impulse. So let's say that right here we have impulse. Impulse occurs first, then the signal. All right. So the difference between the two is the lag that we mentioned originally. Right. Okay. So now, if we take a look at what that impulse looks like, depending on the nature and extent of that price action, it could be forecasting, or order flow could be moving such that we can anticipate a further continuation in the up move, or it can be evolving that the most likely scenario we should be postured for is down. All right, that's a problem. So depending on what it looks like and where the buying and selling is inside this impulse, gives us an indication of what's actually going to happen. Unfortunately, though, any way that this occurs, this can occur in dozens of ways. Any way that this impulse occurs, you're going to get a signal. All right. So as a result of that, then if we take a look at this, so if any impulse gives us a signal, and there's a variety of situations in which that signal can be wrong based on the underlying price action, then now we're looking at, then we're just looking at random outcomes. All right. So what the novice trader will do is they will, which is the worst thing that anyone can do, they will back test this, find that it produces certain outcomes, and then expect to do that in the future. That is not how it works. That is not how trading works. And that isn't what makes you a trader. What makes you a trader is the ability to analyze the impulse so that you know you have an 80% chance with this signal of getting to break even. That's what makes you a trader. Okay, so understanding how to read the order flow which goes into that is what is going to help you. Now, once you've harnessed that and you've mastered it, then these signals can be used very effectively as what's called context. So we're not trying to forecast price with the indicator. We're trying to use it as context. So we're going to find context very quickly that we can analyze to get our 80-85% win rate. Okay, that's the key. And then we can scan for this, which means we can build larger samples more quickly and create a trading business that's efficient. That is why indicators as forecasting signals do not work. They don't work for general people. Technical analysis generally is a failure as a result of that, unless you understand the underlying order flow. And the key is to using them as context, not as outright signals. Okay, everybody, that does it. Master this and you can crack the game. I'll see y'all next time.